Hello everyone, welcome back to my channel. In this video, we will take a closer look at the accounting concepts. The business entity concept. The business is separate from its owners, that is, in the preparation of accounting statements, the business is recognized separately, that is, only things that affect the business must be recorded, not including any other wealth of the owner. For example, Amina's bakery is a separate entity from Amina herself. If Amina's bakery earns 200 naira, it belongs to the business, not Amina personally. The going concern concept. The business will continue to operate for the foreseeable future. That is, financial statements are prepared on the understanding that the business is a continuing business. That is, the business will continue to operate in the future and it's not on the verge of cessation or liquidation. For example, a company like Apple, the Apple company, is assumed to be a going concern, which means it will continue to operate and generate revenue in the future. We have the money measurement concept. All business transactions are recorded in terms of money. That is, all information in the financial statement must reflect facts which are expressed in monetary terms alone. For example, if a company purchases office supplies worth 500 naira, the transaction is recorded as an expense of 500 naira, not as quantity of supplies. We have the cost concept. Assets and expenses are recorded at their original cost. That is, the value of assets cannot be valued in terms of future returns it is expected to generate, but only valued at the cost of acquiring the assets. For example, if a company purchases an equipment for 20,000 naira, it is recorded as an asset at the cost of 20,000 naira, even if its value increases or decreases over time. We have the accrual concept. Revenue and expenses are recognized when earned or incurred, not when cash is received or paid. Revenue and expenses are recognized and included in the income statement as they are accrued, not as they are paid or received. For example, a company provides service to a client in December but receives payment in January. The revenue is recognized in December, not January. So next, we have the matching concept. Expenses are matched with the revenue they help to generate. For example, a company spends 5,000 naira on advertising in December, which generates 25,000 naira in revenue in January. The advertising expense in December is matched with the revenue in January. Dual aspect concept. Every business transaction has two aspects, the debit and the credit. For example, when the company purchases office supplies of 1,000 naira, we are going to debit office supplies with 1,000 naira and credit cash with 1,000 naira. Realization concept. Revenue are recognized when they are realized or realizable. For example, a company sells products on credit. The revenue is recognized when the sale is made, not when cash is received. So, that's it for today's video on accounting concepts. I hope you have a better understanding on accounting concepts. Don't forget to subscribe for more accounting insights, explanations, and tutorials. If you have any question or topics you would like us to cover next, please let us know in the comment sections below. Thanks for your attention. See you in the next video. Bye.